Warren Buffett is one of the, if not the best investor of all time. And for those of you that don't believe this, here are 4 of his biggest wins. Starting from Coca-Cola, which is the stock that actually made him famous, he held this position for 35 years and transformed a $1.3 billion stake in the company to almost $25 billion. Next is Apple, which is one of his shortest held stocks, but because it's a more modern company. He's held this position for 7 years and he's multiplied it from 30 billion all the way up to 151 billion. That's a 5x in only 7 years. Next is Amex, or American Express. In 30 years, he managed to multiply his position from $1.3 billion all the way up to $25 billion. And finally is, I believe, his most impressive one, which is his stake in Moody's. He managed to multiply a 248 million stake in the company all the way up to $7.5 billion, which is a 29x in 23 years. But he could not have done this if it wasn't for his proper valuation analysis that he conducts before starting a position, which is what we'll be focusing on today. So Warren Buffett, the best investor of all time. Everyone has heard of or at least knows Warren Buffett and his investing style, so I have decided to use quotes in order to do his description. The first one, which I believe is the most representative of him: "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." By saying this, he's referring to the fact that he prefers looking at the fundamentals, such as if the company has a moat, if their earnings can be sustained at a high growth rate for the following years, what their management is like, and all those other things, instead of focusing more on valuation. The second quote is, "If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. And this one goes hand in hand with the following quote: "Our favorite holding period is forever," meaning that Warren Buffett is a long-term investor. As we saw in the previous slides, his holding average times for his stocks are 20-year plus. The fourth one, is "Price is what you pay, value is what you get." Here he makes a clear distinction between price and value, and it's representative of his investing strategy, as he's always focusing on calculating the intrinsic value of a company and then buying the stock whenever the price is lower than the value he has calculated. And the final one is, the 3 most important words in investing are margin of safety. Let's take a look at some of Warren Buffett's strengths that have allowed him to obtain this incredible track record. The first one, of course, is his approach in value investing, which is buying stocks that are undervalued relative to their intrinsic worth. This is what I spoke about before, that he prefers to first calculate the intrinsic value of a company and then wait until the stock price dips below the intrinsic value to actually acquire shares. Second one is his long-term perspective. We have seen his holding periods and they normally range between 20 to 35 years, which is incredibly long-term, meaning that he actually disregards short-term fluctuations and focuses on the fundamentals for the most part. Now, he has been seen in some short-term fluctuation bets, such as his stake in Activision Blizzard, but the way he actually made his net worth was through long-term positions. Third one is something that also Peter Lynch is a big fan of, which is investing in your circle of competence. What this means is that you should invest in industries you understand well. For example, in my case, I do not understand about the microchip industry. I prefer to stay away from them since, first of all, I don't understand their cyclicality, and second of all, I don't understand the technology behind the companies. The next one is the quality. He focuses on high quality businesses with strong economic moats and great fundamentals with, of course, solid management. And the last one he commented on the last slide, the margin of safety. You should focus on companies where the intrinsic value of the business should be higher than its market price. So just here, patience is key, as you will have to wait for the stock price to fall below the margin of safety. Some points to consider before moving on to his intrinsic valuation method. He uses no hard math. He uses no formulas, no spreadsheets, and no calculators. He does very simple calculations. He does not play around with the book value, as he believes that great growth businesses will earn a lot more than their assets. Also, he really likes to look at management, which is a very qualitative and subjective aspect to consider. But he prefers to look at the past track record of the company rather than future projections and future guidance, since most of the time those will not be met. So looking at the past track record is a lot more representative of how good the management team actually is. Number 4, in order to calculate the intrinsic value of the company, he projects the future cash flows of the company and then discounts them up with an appropriate discount factor. Number 5, it has to be a no-brainer. The value of the company, it has to hit him over the head that it's a good buy. And the last one is the other factors that he prefers to consider and the ones that he say that have more weight on the decision factors for investing in a company, being the moat, the management, the competitive position, the quality of the earnings, etc. Now let's move on to Warren Buffett's valuation style. He first needs some initial metrics, which in this case it's pretty easy as he normally only uses the company's current free cash flow. From here, now he will project the growth of the free cash flows and of the earnings by using different scenarios. He will normally use a conservative one, an average one, and an optimistic one, and he will use these three scenarios all along the rest of the process. Why is this? Well, this is to have a range of conviction for the company. He feels more comfortable if you have one where all the things will go well for the company and one where all the things will not go so well for the company. Because in case that the company is trading at below the conservative scenario, you will have a higher conviction that you will actually have to buy the stock. Now he decides on a proper discount rate, and this he usually guides himself on interest rates. I believe that he usually uses a discount rate which is 3% higher than the interest rates. For example, right now, if the interest rates are sitting at around 5%, he will use a discount rate of 8%. But there was an interview with Charlie Munger where Charlie actually said that he has never seen Warren Buffett do these calculations. So we can assume that he always uses a 10% discount rate. Next, he calculates the present value of all the cash flows. And in order to do this, he only has to discount the cash flows he has calculated previously using the discount rate that he has also calculated previously. And he does this in order to find the present value and what in theory should be the fair value of a company. And in this method, he's actually comparing or using the same method of valuation than you would use for a bond. And that is great because he breaks down the complexity of a company and he translates it into a simpler form, which is a bond, just calculating the free cash flows, translating them to what their present value would be today, and seeing whether that is enough of a return for him or not. One other step that he usually does is to consider debt. If the company has considerable debt and debt repayments, you should minus this from the calculation of the present value. And after that, you will find the intrinsic value by dividing by the number of shares outstanding and applying, of course, the margin of safety, which he believes is absolutely necessary. Now, some important information. Of course, I'm not a financial advisor, and this is not financial advice. This is just for educational purposes. So in order to conduct effective investing according to Mr. Warren Buffett, you should first of all ask yourself whether the free cash flow growth and the solid margins can continue for the firm. And once you have answered yes to this question, you can then proceed to calculate the intrinsic value. But that question is worth a lot more than the whole process put together. Of course, always remember the margin of safety. When you apply this, you are more sure on your analysis and you can get a more conservative approach and you will sleep better at night once you have actually bought the shares. Warren Buffett, of course, usually uses a 50% as we have stated previously. And then the third one is that the company should have defensible earnings. And what do I say by this? Well, this is talking about the quality of the earnings. They should be predictable and resilient in cases of economic downturns. But thank you so much for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and there is a link in bio for a free stock if you join Trade Republic and Trading 212.